All right, welcome to Trading Nation. I'm Brian Sullivan. We're pleased to be joined once again by Professor Robert Shiller. He is a professor of economics at Yale University, by the way, also a Nobel laureate. Professor, great to chat with you again. Thanks for joining us.
Nice to talk to you, Brian.
All right, well, your preferred measure of stock market valuations now at the highest level since the technology bubble. Is that the warning sign it sounds like it is, or is something changed where high valuations, the CAPE ratio, as you call it, aren't necessarily something to worry about?
Well, there's a lot of dispute about that. The CAPE ratio has been relatively high for 20 years now, so you might imagine that something has changed. On the other hand, maybe not, and it's been a fairly reliable indicator. Now, it's not super high. It's not like it was in the year 2000, where it set a record of over 45. Now it's about 29, that's high, but it doesn't suggest an imminent disaster. And so one has to think of other things, like diversification as well, when considering investing in the U.S. stock market.
Is it high enough to worry about?
Yes, it's high enough to worry about. You know, at this level, I think it suggests that the expected return for stocks might be negative, but only slightly so. Might well be on par with, 1% real. So it's not signaling necessarily any imminent disaster. The market is not that forecastable. So my general thought is that I think it's quite reasonable to have an investment in U.S. stocks as part of a diversified portfolio. Just don't go overboard on it.
Well, how about this? Let me ask it a different way, Professor. Should the portion of someone's portfolio that was equities be reduced a bit?
Yes. Well, if you looked at my calculations using only the CAPE ratio, cyclically adjusted price-earnings ratio to forecast, that would suggest, yes, reducing your holdings of stocks. Even for a long-term, especially for a long-term investor. We don't really know when we can't time the market accurately, but we know that when it's this high, over long term, it usually doesn't do great. On the other hand, there's many other considerations that people will want to take in. Still, I just don't think this is the time to be.
What are those things that we need to be really focused on right now?
The thing that comes immediately to mind, I hate to be the one who brings it up, but it's Donald Trump and his tax cutting. So he says he wants to cut taxes, both personal income taxes and corporate profits taxes, and also to cut regulations. So he says he had proposed this 2-for-1 regulation rule, that for every new regulation we have to cut 2 old regulations. Well, generally, these regulations are not there to help business. They're there for a reason, but it's not help business and profits.
Correct. That's why he wants to reduce them.
That's right. So all these things point to a higher market. And if you think those things are going to happen, that's a reason to expect better from the stock market. And that's not all. It's also, I think, the Trump psychology. And I don't know where that's going, but at least for believers in Trump, Trump is an inspiration. I believe that inspiration matters. He's kind of like a motivational speaker. He's exciting, at least for many people. And it could lead us to a kind of increase in confidence.
And what's your biggest worry right now? You get deregulation, you just referenced as a potential positive. What's the big negative that you're worried about? Is that maybe that nothing gets done, or is there something exogenous we haven't even talked about yet?
My biggest worry is international relations with this immigrant restriction, trade war. A trade war, if we cut tariffs and nobody retaliates, that should be good for business. But history shows that other countries retaliate, and in the long run, that isn't good.
You think it's likely, or is just something that you answered my question, but do you believe it's something that could actually happen, Professor?
I think it could happen. Trump is keeping his promises, and that was one of his promises. He didn't say it would work out well. He can't promise what the Chinese will do in retaliation. But the whole thing strikes me as a serious risk, that it will, our prosperity has been substantially driven by help from China. I mean, they ship all these cheap goods to us, and they're good stuff. And we don't have to, we all benefit from that. Now, I know there are some people who suffered excessively, people who lost their jobs to Chinese. I recognize that's an issue. But if we're just looking at predicting the stock market, it may not be a good thing that we put on trade restrictions.
Professor Robert Shiller of Yale, always a pleasure. We're watching a CAPE ratio a little bit high. You're not that worried about it. Diversify a bit. And we're watching, obviously, the whole financial world, unfortunately, is inside the beltway right now, Professor Shiller. Thank you very much for joining us.
All right.
Folks, thank you for tuning in to Trading Nation. I'm Brian Sullivan, and we'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.